Hello, everyone, and welcome back to the channel. If there is one investment strategy that consistently works, that doesn't need you to be glued to the news, and that doesn't ask you to time the market, it's definitely investing in globally diversified ETFs. In today's video, I'm going to show you why this approach is the most pain-free long-term strategy out there and how you can start with zero stress. We'll also compare it to stocks, real estate, and all the shiny distractions that might be costing you time and money. Let's dive in. Now, let's start with the basic. If you invest in world ETF like Vanguard's VT or similar composition, you are buying into thousands of companies around the globe. Apple, Nestle, Toyota, Samsung, you name it, it's all there. It's global exposure in a single click. Now, if you want to simplify even further, many people would go to just an S&P 500 ETF like VOO or SPY. These track the top 500 US companies and have delivered 8 to 10% annualized returns for nearly a century. This is what Warren Buffett recommends for 99% of the people. Like he mentions explicitly like this: a low cost S&P 500 index fund is the most sensible equity investment for the great majority of investors. So if Warren Buffett says so, why to go for the world ETF instead of just the US? Now, this is my perspective. You may agree or disagree, but this is how I think of it. Now, the first point here is geopolitical diversification. If the US slows down or faces uncertainty, your investment in Europe, Asia, and emerging markets can provide you a balance. The point about currency diversification is also important. If you are earning in pounds, if you're earning in, let's say, INR or euro or any other currency which is not pegged to AED, then if you're investing in the US market, you are always having the exposure of US dollar. Although we can debate on that because a lot of US companies are also having exposure of outside world, but still a global fund spreads that currency risk. Now, hands off allocation is also one important point that I always advocate, because you don't have to manually decide which country or sector to bet on. The ETF adjusts over time based on the market size and performance. Like you don't have to worry about UK underperforming and let's say Germany overperforming, or let's say performing at much better pace. You don't have to worry about selling off your UK let's say equities and buying German equities, because the ETF will automatically balance everything out. It's a set and forget strategy that works, especially if you're not looking to make investing your full time job. A few days ago, an old friend of mine messaged me. He said, I've been watching your videos. I like your logic. Can you send me your exact stock portfolio? Now, I laughed and said, I even don't blindly copy my own portfolio or any other's portfolio, because there are so many parameters that goes into constructing a portfolio for one specific person, because markets are dynamic, news changes daily. For example, today, as of recording this video, Elon Musk and Donald Trump got into public feud. Who would have thought that 3 weeks or 2 weeks or 1 week even before? And because of that, Tesla stocks dropped more than 15% in one single day. Musk criticized Trump's new tax bill for cutting EV incentives and keeping oil subsidies. Trump hit back, saying he's disappointed with Elon, and hinted that Tesla is just worried about losing money. Now, by the time you're watching this video, perhaps maybe a week, 2 weeks, or 3 weeks later, the story might have flipped. Maybe they made peace. Maybe it got worse. Maybe Tesla rebounds or drop again. So it's all fluid. Now, this is how unpredictable and fluid the situation of individual stocks, especially once you're talking about Elon or Donald Trump or people like that, can be. So when someone says they want to copy your stocks, I say you are not copying the returns, you are copying the emotional stress as well. Unless you have time, energy, and mental bandwidth to monitor every headline, this stuff can eat you up. That's why I prefer ETFs. With a world ETF or an S&P 500 ETF, Tesla is still there, but it's just one slice of a much bigger pie. Now, let's talk about real estate. I mean, I love real estate. I invest in that too. But let's be honest, it's not as simple as people make it sound. It has high entry cost, maintenance, repairs, and tenants issues, legal complexities, mortgage and interest rate risks, delayed liquidity, and you can't sell the property in just 2 days. Unlike ETFs or stocks, you can do very quick transaction as you like. A lot of people feel in control with real estate and when they're talking about real estate. But are they? Are they actually in real control? Because when you zoom out, you are still dependent on the market regulations, city development plans, and tenant behavior, all all of which are out of your control. Compare that with ETFs: no repairs, no late night calls, no dealing with agents or tenants. The only thing with real estate which is lacking with ETF investing is the leverage. But that story of another video, because that's the double-edged sword. As you know, that leverage can go up or down depending on the situation. Now for ETFs, you can start with a small amount and build gradually, all while keeping liquidity and peace of mind. I made several videos about how to invest in stocks, real estate, let's say ETFs as well. I've linked all those kind of videos in the cards here. You can go watch them out. I also talk about different platforms that you can invest through. I compared in recent video. I've compared different platforms of stocks broker that I use myself, and you can watch that video as well. So now, what's the ideal strategy for most people? You can keep it very simple. Get into 100% world ETF if you want complete peace of mind, or 70% world ETF and 30% S&P 500 if you want slightly more of US exposure, or reverse it depending on your conviction of the US economy. Like for me, I keep some portion of US stocks as well as the ETFs. I've got that exposure, and also I've got the exposure to the world ETF. Although I know that the world ETF exposure already is given me almost, let's say, 60 to 70% of the US stocks, but still I keep some US stocks or ETFs separately. Either way, you are diversified. If you are invested in thousands of companies across the multiple countries and industries, you are not trying to be smarter than the market. You are just giving yourself a reliable path to wealth. And you can always add real estate or individual stocks later, but build your foundation with broader market ETFs. Now, there is no investment advice here. I have seen through all the data myself. There is not much that we can do for individual stocks. I cannot, let's say, predict what Tesla would do, how Apple would perform after 10 years. But I know if you are investing in the ETFs, they have a sustainable path towards the growth, and we've seen this happening over the last hundreds of years. I won't say hundreds of years, but at least we've seen 1 century of the let's say the pattern or the trend. Now, most people don't fail at investing because of the bad product. They fail because of the wrong mindset. These try to chase trends. They panic during volatility. They don't stay invested long enough to let compounding do its job. The magic of ETFs is not just in their returns, it's in psychological simplicity they bring. No drama, no hype, no, just quite consistent growth. And if you grow at 8% per year, your money doubles every 9 years. Staying consistent for 2 decades and your money could be 4x or 8x without losing sleep. Now, that's not bad at all. You will be far better if you are invested in any other asset class, because we've seen, if you remove leverage, what we've seen, stocks have been performing the best compared to all the asset classes. So here's the bottom line: if you want to invest that's low stress, globally diversified, and historically reliable, you cannot go wrong with the world ETF or an S&P 500 ETF. No need to be a stock picker, no need to be a landlord. Just focus on starting early, staying consistent, and thinking long term. I have my own course around this topic of how to build wealth as a GCC expert, which is linked in the description of this video. You can go check that out as well. If this video helped you, hit the like button, subscribe for more, and let me know in the comments, are you investing in ETFs as yet? You can go check the links in the description of this video. There are several platforms that I talk about on this channel. There is Sarva, there is Amana, there is Baraka. You can invest through these platforms and get somewhere between 150 dirhams to 500 dirhams of referral bonus if you use my link in the description of this video. And then you can join the community as well. The people who are thinking about investing, thinking about growth. This is also a link. There is a link in the description of this video. We run this WhatsApp community. The cost is not that much. We don't give any signals or anything. We just talk sane on those groups that I'm just talking about. There is a free Discord community as well that you can join as well. The link of that is also in the description of this video. I recently made a video about payday routine and what an ideal payday routine could look like, which is available here in the end screen. You can go check that out. And there is another comparative analysis of all the brokers that I invest through. Here is the link to the video, and you can go check that out. How did you like the video? Do let me know. Thank you very much.